Okay, those are the headlines that we'll be tracking for you all evening on ET Now, so stay tuned. But back on the Money Show, today we are going to be talking about the underlying assets in a mutual fund. And the reason why we decided to talk about this is because after DHFL, after RLNFS, and after several companies that have gone down under or have had repayment problems, here's another one that could potentially hurt investor pockets, and that's Vodafone Idea. In fact, the entire telecom basket with a massive 20,000 crore rupee and more than that AGR penalty due, it does certainly beget the question that which mutual funds are holding Vodafone Idea instruments or Vodafone Idea issues. And there you have it on your screens. Those are some of the mutual funds in the debt side that have exposure to Vodafone Idea's paper. That's the percentage of the AUM as well, by the way, that it is exposed with. Remember, the larger the percentage of the AUM that it is in a troubled company, the more badly the NAV could be hit. You guys do remember what happened to the DHFL Pramerica funds and what sort of a crash it took in one single day. We saw 50% wipeout in the NAVs, and that certainly is very, very disconcerting. Which sort of then brings us to the question, how closely should one look at the underlying assets when they're investing in a debt mutual fund, or for that matter, even in an equity mutual funds? So we'll take forward this conversation with Harshvardhan Roongta of Roongta Securities. Harsh, thank you so much for joining us on the Money Show. So let's understand firstly that what is your own assessment of the debt mutual funds that may be hit because of this new crisis that's brewing, and this time around in the telecom sector. Yes, we do have the finance minister saying that, you know what, wait, I am going to come in with some rescue package. But until then, naturally, the value of many of these papers that have been issued by Vodafone Idea specifically has come down quite a bit. So how are you reading into the entire thing vis-a-vis mutual fund investors?
So, well, Mubina, the issue is that as an investor in a mutual fund, you have no control as to which investments the fund manager will do and which papers are they going to invest in. At best, you can do is before investing, you can have a look at the fact sheet and see what are the kind of investments that have been made till now, what are the credit ratings for that investment, what is the percentage allocation to one particular segment, one particular company or one particular sector. So these are the things that you could possibly have a look at before making the investment, but you have no control in guiding the fund manager as to which kind of papers they can invest into, nor do you have any control as to which paper they're likely to invest in future. So in that sense, there is limited intervention that an investor can do. Besides, I mean, there are so many schemes with so many different options available. I don't think a layman investor will be equipped enough to go into the details of each and every portfolio to decide. So it's simple. Let's just follow a three-step process. This is a simpler way to go about doing things. The first is the investor needs to really understand which type of scheme that they wish to invest into. So within the debt category, you will have a couple of options available. Namely, you would have an overnight fund to start with, you have a liquid fund, you have a short-term fund, you have a medium-term fund, you have gilt funds, you have different funds which have different objectives of investment. So the underlying duration, the average maturity paper that they're holding are also known in these particular different kind of investments. Further, an investor should also be very clear in their mind as to what they don't want to invest into. So if you're a risk averse investor, and that's exactly how a debt investor should be, you could possibly very clearly decide in your mind that I don't want to invest into any credit risk funds. So wherein they will invest into lower rated papers, but there is a potential possibility of getting higher returns. So an investor needs to be very clear in their mind that I don't want to do this. Another category which a risk averse investor might want to consider is not to avoid a long-term debt fund, because if interest rate movements have the largest impact on the long-term papers rather than the short-term ones. So if they don't like volatility in a debt fund, then you should avoid long-term funds. You should avoid credit risk funds. So first step, as I mentioned, is to decide which type of scheme you want to invest into. The second step would be which are the AMCs that you would want to entrust your money with. So you could select a handful of AMCs, and you could filter them out on several parameters, saying that I want to invest with the largest 5 or largest 10 in the country in terms of assets that they manage. Or I want to see the past performance and how they have weathered all different time periods, and how they have performed in different time periods is something that you could look at. The third parameter you could see is that is there a fund house which does not allocate more than say 3% or 5% in any one company or any one sector. So these are the parameters you will possibly take into consideration and shortlist the AMC that you want to invest into. Then the third step comes in when you actually pick the scheme to invest into in that particular AMC within that category of the scheme that you've chosen. Now, if you look at the actual practical process undertaken by an investor, it's exactly the opposite. You will go on an aggregator's website, you'll try and see which fund is giving the best returns. Now, when you see a credit risk fund giving you a very high return, and then you see an overnight fund or a low duration fund giving you lesser returns, you will have a tendency to look at the higher fund which is giving you higher returns. Now, you have to understand a credit risk fund is giving you higher return because it's taking that additional risk. If you're looking at only returns and then comparing an apple with an orange, you will likely be wrong in your selection. So go the stepwise that I've said rather than going the other way around. You cannot look at the returns in a debt fund and then pick a scheme. You're supposed to identify what you need and then look at a scheme which matches that particular requirement of yours. Irrespective of the fact that on a comparison chart, that particular scheme is giving you lesser returns, you should be possibly looking at investing in that kind of a scheme. And one last piece of advice for debt investors is that debt investments are essentially for capital preservation. You do not look to maximize returns on your debt investments. If you want to maximize returns, then there are hybrid products or a pure equity fund, which a returns is the objective. Within debt, your goal is capital preservation, and that is what comes from a AAA rated kind of a paper, a gilt fund possibly, minus the interest rate movements. Of course, there's no credit risk on a gilt fund, so you might want to look at getting less returns is fine, but your capital should not be eroded. So the attitude has to be very clear while investing into debt funds, and then I believe you will be able to weather these kind of developments like a default or a possible defaults and rating downgrades, the valuations going down. All this you'll be able to take better in your stride if you followed the steps properly.
All right. So I think that's basically the do's and the don'ts, and unfortunately a lot of investors follow the don'ts when they are picking a debt fund or credit risk fund or whatever kind of fund they want to. So basically, Harsh, like you rightly mentioned, most retail investors don't have the wherewithal, the knowledge, perhaps with the experience to decide that, okay, what the mutual fund manager is investing in is a good asset and I want to be in that or not. So would you say it's absolutely a fruitless exercise for the retail investor to actually go in, unearth the skeleton, unearth the fact sheet and see each individual asset? And also you mentioned about the risk factor. So let's say if I am risk averse, I do not want to take a very risky approach, and that's obviously why I'm in a debt mutual fund. Do you think then I should just perhaps look at the rating of the mutual fund overall by a credit risk agency or on the individual stocks held by the mutual fund?
Credit ratings, the star ratings per se that have been allocated and assigned to a particular scheme are all individual. It's about the person who's giving that rating. So you will have an agency A possibly giving 2-star to a particular scheme. You will have an agency B giving a 4-star. Now they have their own internal parameters to decide what is the ratings that they're going to give. Now, I don't know how much would you want to entrust upon that rating by agency A or B. So your faith in that agency giving the ratings is very important. So who is giving that rating has to be kept in mind. However, for a person who's absolutely new to this, even ratings mean the same as much as particular scheme holdings will make. So there's no difference between the two. You would possibly be better off if you take experts' advice, because every field has a set of people who are tracking this more minutely than what somebody else will be doing. Now we would take medical consultation or law, a legal consultation, because we're not from that field. Similarly, if you're investing your money, you might as well approach your investment advisor and possibly take the advice, because they've done that kind of work for you. For a person who's slightly aware from a financial background, is intelligent, is able to comprehend information that has been financial information, particularly if it's been put before them, so they could go into the fact sheet a little bit and apply common sense. So it's not too difficult to understand, quite honestly. A few things that you will have to see if I'm investing. If I've shortlisted a scheme A, suppose I'm choosing to invest in one particular scheme, just look at the portfolio of that scheme. It is very clearly indicating to you how much of that portfolio has been invested in only AAA rated papers, AA, or there's a single A or something like that. And what is the allocation? So there is a percentage allocated against each paper that they're investing into. Even in a sector allocation is being mentioned to you. So you're wise enough to understand that if an investment has been made in excess of 10 or 12% in a particular company, what happens if that company goes bust tomorrow? So you can take a decision accordingly. If there is an allocation of 3% or 4% or 5% given, maybe it's okay. You can go ahead with investing into those schemes. So these are some basic parameters. You don't need to be very intelligent, but if you have some financial, you're good with the nuances of these basic analysis, then you can go ahead and look in the fact sheet. If you're not, then of course you take the help of an expert in that particular field.
Okay, got it. All right. So, I see at the end of the day, our investors want to know, hey, what do I do? I have, say, a Franklin Templeton or an Aditya Birla Sun Life, and, that has exposure to Vodafone Idea. So, what would be your recommendation to all these mutual fund holders of Franklin, Aditya Birla, UTI, Nippon? They are all holding Vodafone Idea debt paper. So, what would you recommend they do?
So the current investors, the ones who are already invested in those schemes which are likely to be affected by these kind of delay in repayments or defaults of Vodafone Idea that we're hearing about now. So the first step is, of course, look at the allocation. So as we know rightly already that there is an allocation of up to 3 to 5% in most of the schemes. So at this juncture, if you were to redeem, now this information is already out in the market. So it's not that you have a privilege to that information and you're trying to exit now when something is going to happen tomorrow. That's not the case. So in all likelihood, the valuations have already been incorporated and the possibility of defaults are also reflecting in the prices and the NAVs right now. So all I can say right now is I think it's a little too early to panic. In specific case of Vodafone Idea, it's a little too early to panic onto that. I would say if the allocation is up to 5% of the total AUM of that or the assets of that particular scheme, I think at this juncture you can just sit tight and just follow the processes, follow the developments a little more carefully. But in case you are really uncomfortable and don't want to wait until a good or a bad news either ways comes to you, then of course you can exit and park your money into overnight kind of funds or a liquid fund, which are far more safer than these kind of schemes. So yes, just to sum up, if you're comfortable with the 3 to 5% exposure, I mean, just stick on because the price has already been incorporated, all the news has been incorporated in the price already. If you don't want to wait for either ways, then exit out and stay into a AAA rated or a gilt fund kind of a thing, which will be far more safer, at least from the credit risk point of view.
Okay, all right. Well, yeah, it's a known fact. So it's already priced into the NAV. I mean, if you guys will go online, check on various portals, you'll see the NAV perhaps has already adjusted this event into the price. So now I suppose if your fund is holding less than 5% of the AUM, which I think with the exception of the UTI credit risk fund, most of them were holding under 5%, then don't panic much. That's Harsh's advice for all the viewers out there. But on that note, we'll kickstart our Ask the Money Show segment. So if any of our viewers out there watching us on television, on their mobile phones, iPads, whatever pick they would like, if they have any questions or queries that they would like Harsh Roongta to answer, you can call us right now on 24990300. Quickly email in as well. Phone lines preferred because it's an instant answer. But let's take on board our very first question. It's coming in from Senthil Veland. Now, Senthil Veland writes into us saying, I need 20 lakh rupees for my older daughter's higher studies in 2025. He's been investing 12,000 rupees per month in equity mutual funds. Now, his question is it enough to reach the goal? Okay, now unfortunately, he's not told us since how long he's been investing the 12,000 rupees per month, but fact is his SIP is already on. So now he has around 6 years left to go, by the time he'll need the money, the 20 lakh rupees. So firstly, Harsh, would you say that 12,000 per month to reach 20 lakhs in 6 years is sufficient? What would you recommend him to do?
Well, Mobita, if we were to look at in the absence of the information that he's been investing since how long, if we were to assume that he's just recently started investing, so in less than a couple of months from now or just about to start, in that case, if we look at 12,000 rupees per month and we extrapolate that for the next 6 years also, accumulating 20 lakhs looks very difficult. I mean, and equity may not be the asset class if you're looking to invest for even 6 years from now, specifically considering that the goal is for the education of his daughter. Now, what happens with a goal like an education or a holiday? So I just want to make one categorical difference for the benefit of all viewers as well. If you're investing for a particular goal, which is education, remember that goal cannot be postponed. It cannot be said that, okay, after 6 years, if my equity markets are not doing well, I will give her that higher education after 2 years from then. That does not happen. So when you're saving for education, try and be a little conservative. Lesser returns is fine, but try and be a little conservative. 6 years time horizon is good enough for equity, but because it is a daughter's education, is what he's trying to save for, I would recommend that go for a hybrid fund. It could be an equity hybrid fund, an aggressive one, which has a 70% in equity and 30 in debt. But I think that is far better than having 100% in equity right now. So my suggestion to him would be to go into a hybrid fund, such as a SBI hybrid equity fund or a Canara Robeco hybrid equity fund. And 12,000 most certainly is going to be a less amount of money that is going to, it's not going to be sufficient enough to accumulate 20 lakhs. In my opinion, if he was to accumulate 20 lakhs for sure, then he has to invest about 21 to 22,000 per month. Nevertheless, I mean, whatever you can do right now, I think he should go about investing, which he is doing. So continue with the 12,000, but take a hybrid fund and not a pure equity fund. And as and when you can increase your investments, please make sure you do it, because there is a stopgap, there's a gap between what you need and what is going to be accumulated with this kind of investment. So I think that's the kind of advice I'd like to give him at this juncture.
Okay, well, a daughter's education cannot be postponed. It's not a holiday, or even buying a house for that matter. All things being equal, that it can be postponed maybe by a year or two. So, and equities, it's not necessary that the movement in the market will support your own exit time. So hence, a hybrid fund is being recommended. But if that's the case, then you may require a higher amount. So I hope, Mrs. Senthil Villain, that's aided your gathering the 20 lakh rupees. Okay, we have another caller coming in right now. It's one of our regular viewers, Japesh Thakur from New Delhi. Hi, Japesh. Hope all is well with you. What's your query today for Harsh?
Today, let me start off by thanking you specifically, Mubina ma'am, because if you recall, the central theme which you are covering today, about the need for an investor, retail investor, to look at the underlying portfolio. You may recall about a month back, I had posed this question to one Mr. Subramaniam,
yes,
who had been part of that panel on that particular day. So thank you very much. Now I have a lot more color and nuance to that particular question. Now, as far as today is concerned,
yes,
I would like Mr. Roongta to kindly explain to us in a little bit of detail the difference between, a low duration fund and a short-term income fund, because SEBI has made this distinction categorically. And I also wanted to know if he could tell us that whether these particular nomenclatures, is it only meant to be a signal to the fund manager, or is it that, as retail investors, we also need to take care of these terms so that, our time horizon, etc., gets decided by this? So, thank you.
Okay, fair enough. Firstly, Japesh, I really am extremely pleased that you are able to make the most of the money show. So thank you as well for your very kind words. Okay, Harsh, let's get his question answered. He basically wants to know the difference between the two nomenclatures. Now, his question is that, is it something that is put in place so that mutual fund managers have to sort of invest knowing their restrictions because of the nomenclatures, or is it also for the benefit of investors that, okay, there's a short-term income fund, so I should put my money, I should not. Okay, this is an XYZ fund, so whether I should put my money or no, in which way does it work?
So, well, Mubina, this recategorization and classification of schemes that SEBI had proposed was purely from the fact that the investor should very clearly know what kind of scheme he or she is getting into. So prior to this scenario of recategorization and reclassification, I mean, we would have any names that were given to the schemes, and the underlying objective never actually gave out the true picture of what the scheme is doing. So you would have an XYZ fund saying that it's just an income fund, and they would hold, somebody would hold papers which were for, say, probably average duration of 2 years, somebody would hold for 7 years. So this would never give a layman investor a clear idea as to what the fund is doing. The biggest beneficiary of this particular recategorization in the debt segment is the credit risk fund. We would never have any scheme prior to the reclassification being named as credit risk. the moment you would write any nomenclature with the word risk involved in it, nobody would invest into it. So the fund houses would never write credit risk fund, and they would just simply write a corporate bond fund or something like that, and the investor would never know that they're actually investing into a scheme which invests into low rated papers with a view to generate higher returns. So first answer is very clear. The recategorization, the entire exercise is nothing in fact to do with the fund manager. It is to give the investor a clear view that he or she is investing into a fund which is a, say, probably low duration fund. That was one of his questions, that this is going to be invested in papers, the scheme is going to hold papers which have a low duration. So when you have low duration investments, very clearly the movement of interest rates will have the least impact on these papers. So if you don't like interest rate volatility to you, in your investment, then you would possibly look at the lower duration kind of investments. Now short term, each fund house will have a particular category to say that I invest into papers which are, say, 3 years, or they're 5 years in nature, or 7 years in nature. So the underlying idea is very clearly stating that these are the kind of papers, or this is the duration that this particular fund will have. Like an overnight fund is very clearly saying the scheme will invest only into papers which have 1 year maturity, or 1 day maturity. Liquid funds will have 90 days maturity. So these are very clear nomenclatures for the benefit of investors only. What I recommend, there are 16 such categories within the debt segment. So from an academic point of view, it sounds very interesting to go on finding out what is the difference. I think from an investor's point of view, Jitesh is well off to simply say that, do I want to take a low duration exposure, medium or long term, and within that category, which are the best and the most safest for me. I mean, that is will be much faster and much efficient way of going out selecting his funds. So I hope I've answered Jitesh's answer without getting into too many technical aspects, but just give an overview of what exactly he or she or any other investor for that matter should be looking at.
All right, Japesh, I hope that's made things easier and clearer for you. Let's take on board our next caller. It's Naveen Kumar from Pune who's joining us. Hi, Naveen. Good evening. What's your question?
My question is that we saw the list of those mutual funds
Yes.
which in the Vodafone were affected, but what we could make out was that there were hardly any credit risk funds in those, and these being riskier funds somehow did not figure out in the list. So that is my first question, that credit risk funds supposedly are riskier, but they also are safe because the fund managers make it a point to double and triple check the credit worthiness of the people they lend to. So that is why I suppose credit risk funds do have some safety because of this. And secondly, if I have to, let's say, withdraw my money from a credit risk fund for safety, is it worth it to pay the 1% exit load and move out to a safer fund? And I'm quite happy paying 1%. So what would you advise me on that?
Okay, all right. You know, your point is fair because technically a credit risk fund has to put a majority of their money in those lower than AA rated papers, if I'm not mistaken, Harsh. So yes, how would you respond to Naveen?
Naveen, your questions are absolutely bang on. So the first question that you asked was that aren't credit risk fund much safer in that context because they are taking a known exposure into those papers. So, the duty of the fund manager is to make sure whichever fund they're managing, they're sticking to the objective. So if they're investing in a credit risk fund, they have evaluated the risk involved in that and they're investing in it when they're already rated, say, probably a single A or a B, for that matter. So if they're investing in those papers knowingly and the investor is knowingly investing into those schemes, then there is no surprise element in that sense. The problem arises when you're looking at investing into, say, probably, as you rightly mentioned, there are hardly any credit risk funds, but there are some low duration funds which are also owning these kind of papers. So now there is this issue which SEBI has also taken up, is that a triple rated fund suddenly becomes a default category overnight. So what are credit rating agencies doing in this particular context? So SEBI has already started working on it because they don't want these kind of surprises to say that at one point in time a paper is AAA rated and in just 1 week's time the financials deteriorate so fast that they've suddenly become a default category paper. So the rating agencies are responsible particularly for this. So SEBI is working on that issue and hopefully there will be some kind of mechanism in place that you will not find an overnight default. You probably will start seeing the signs of default and the ratings will start going down gradually rather than from a AAA to a default category altogether. So well, as I said, the only thing that an investor can do at this juncture is to ensure that the exposure of a particular company or a sector in any scheme is not beyond a permissible limit or a comfort level, which is say probably 5%. So if I were to invest in a particular scheme, I will only look at the exposure that that company, that fund has in any company or any sector beyond a particular limit. If I am ensured that, because even I don't know, even the fund manager wouldn't know who's going to go completely, from a AAA to a default category overnight. So might as well, the only thing that I can do as an investor is to make sure that the exposure is only limited to say probably 5%. If I've done that, my losses are restricted to 5%. Your second question, if there is an apparent loss or a higher risk being seen in the near future, it is much wise to actually pay 1% and get out of it and save the other 99% of your money. I mean, if I would know for sure there's a company or the scheme is going to go completely default in the default mode, I rather pay 1% and get my 99 back rather than have the entire 100% being over there and lose everything. So yeah, of course, it makes more sense. If you're not comfortable with credit risk funds now, I mean, pull it out despite the exit loads. I mean, not the exit load should not be a deterrent. It should only be something that tells you that okay, to hold on for some more time if you can, but if you don't want to, pay the exit load and move out of it completely.
All right. I hope, Naveen, that's helped you in your question. But with that, we will shut shop on Ask the Money Show. Harsh, thank you so much for very patiently answering all of our viewer questions and queries. And folks, if we've not been able to take up your query, don't fret. We have 4 more working days of the Money Show this week and thereafter as well. So continue staying tuned to the Money Show. We'll try and get your question answered. Quick break. When we return, it'll be our Meet Your Fund Manager segment with one of the best performers of the last 1 year, Shreyash Tevalkar.